So I focus on three main entry models: fair value gaps, inverted fair value gaps, and order blocks. Now, let's say you don't want to trade ICT, or you think ICT doesn't work. Feel free to use various methods, such as VWAP, moving averages, volume profiles, whatever resonates with you. Because why do they all work? It's because the context and narrative of the market is already in place with steps 1 and 2. Okay, we have a swing low in the market that's telling us the market's bullish, and then we get a swing failure pattern. So what that essentially tells us is the market is still bullish, but they're trying to manipulate people into going short. Now, if there's no follow through for the bears, then obviously the market is just going to continue higher. And at that point, when you get the context and the narrative correct, you can really use any type of entry model, because honestly, all of the heavy work and analysis is already out of the way. So again, these are the entry models that I use. I'll use a fair value gap, which is a 3 candle pattern that leaves a gap between the high of candle 1 and the low of candle 2. So what I look for is a retracement into this area. I'll enter long, put my stop loss around here, or maybe at the lows, and target a 1 to 2 or 1 to 3. And an inverted fair value gap is essentially a fair value gap that gets broken to the upside, and then we wait for the retracement. Now, what's the risk management behind this? So stop loss obviously is a logical area based on the entry method. So obviously a logical area based on the entry method. If you're using VWAP, maybe you want to put your stop loss below the VWAP. Or if you're just using a candlestick pattern like an engulfing candle or a pin bar, you want to put your stop loss below the low of that candle if you're attempting a long. Now, what we're looking for is a fixed 1 to 2 or 1 to 3 risk to reward. Now, you're going to take 1 or 2 attempts per day.